everybody, and thanks for joining us for another episode of Off the Charts. I am Mike Lucas, the CEO of True Shares. And for those of you that have been with us in the past, this is our ongoing series where we speak to investment professionals within the ETF and investing business and talk a bit about their expertise and how it applies to the environment that we work and live in every day. So today we're really pleased to have Mohit Bajaj from WallachBeth, and Mohit is a managing director at WallachBeth. And Mohit, thanks for joining the show. Really happy to have you.
Thank you. Thank you for having me.
So you and I were speaking offline a little bit about the influx of ETF issuers and particularly new ETF issuers in the marketplace, and the aspects of the learning curve that are just a reality to this business. And for me, when we started the True Shares back in 2019, I know one of the most interesting parts of the learning curve was capital markets. And capital markets in the ETF space are vital, right, to the issuance of your product, the smooth trading of your product and fund, and then obviously the investor-friendly nature of an ETF. A lot of these characteristics, like tax efficiency, daily trading, liquidity, all of these things are driven by the capital market side of the coin. And so happy to have you here today, and thought we could lean on you for the first segment here and talk about, what are the types of things that you encounter at WallachBeth when it comes to educating ETF issuers, ETF buyers? I know you work with a lot of large ETF buyers as well. And sort of what do you see every day that jumps out at you as sort of the top 2 or 3 things that either are misunderstood or folks are not educated enough on?
Yeah, the biggest question mark we get is why are my spreads 5 to 10 cents wide, if not wider? How come they're not always a penny wide? And two, if I had a client who wanted to buy 50,000, 100,000 shares, I only see 100 shares offered in the market. If they bought that in the marketplace, would that get ripped up 20 cents, 30 cents, if not higher, right? So one of the
Mhm.
biggest illusions we get is just trying to convince an investor that if you peel back the curtain a little bit, there's going to be ample liquidity depending upon the nature of your ETF. Over when I first started doing ETFs, this is like many moons ago. Um, there was only a handful of ETFs. A lot of them were very illiquid, right? They didn't have underlyings, were a little bit harder to source. But now, as ETF issuers have gotten smarter, they put more liquid instruments into their funds, which allows liquidity in large sizes to be easily sourced. So one, don't let the nature of the ETF as far as what you see on screen dissuade you from purchasing a large block, because you should always talk to like a trading desk you work with. Sometimes your custodian, depends on who your representative is. Some custodians have knowledge in the ETF space, some don't, right? It just depends on who you liaise with. But always talk to your capital markets desk, especially at an issuer. They'll be able to guide you on the right path of how to source large pieces of that ETF whenever you need it.
Yeah, absolutely. And we spend a lot of time doing that with investors. We say, look, we will help coordinate with a market maker out there to make sure there's depth, to handle whatever your trade is, a buy or a sell on the other side. I mean, who do we who do we really blame? It's sort of, we blame stocks for this, right? Because everybody thinks because it's listed, it trades just like a stock, where if there's more demand, it's going to drive the price up, when it's not really about price, with an ETF. Is that kind of accurate?
Yeah, I mean, part yes and no. I would say, like, usually with new ETFs, unfortunately, you tend to see a lot of them trade at premiums, right? Because
Hmm.
the market maker, who initially is maybe the lead market making that fund, or there's only a handful of people making that name, they're gonna trade it at a premium to its net asset value, its NAV, because they have to make money for essentially warehousing that position, right? So
Yep.
if you usually you tend to see newer ETFs trade at a premium. So that's why whenever we talk to uh, investors looking to purchase an ETF, we always tell them about their round trip costs.
Mm,
Because if you ever wanted to get in, hey, I can get you done on the offer or maybe inside that offer. But if you ever had to sell that ETF, something happened, right? It's quite possible you might have to take a small haircut on that name. So
mm.
those are conversations we like to have with people so that they know what their total round trip costs are.
So if you have a spread that's wide or drifts quite a bit, and we do have that sticker shock, right, where folks think, oh, it's going to be a penny, it's going to be like SPY, and you're like, no, it's never going to be like SPY, um, particularly given different asset classes as well. But as an issuer, what's the best way to solve for that? Is it creating or actively trying to create a larger roster of market makers that quote the name?
It's yes and no. It's like almost like a chicken and egg problem that issuers have. I think one, yes, you want more market makers quoting that name. Um, Two, you also need buyers and sellers out there, right? So the market maker will only do so much. At the end of the day, a market maker is going to try to do best for themselves, right?
Yes.
But you need to have that retail presence. So whenever you see a newer ETF out there that only trades a couple thousand shares, the goal from a cap market standpoint is to make sure that the word is spread and there's a lot more retail buying out there. Once that retail buying actually happens, that couple thousand shares every day or every couple of hours, right? It'll eventually, the spreads will tighten and there will become more market makers who would want to start quoting that ETF, right? If they start seeing activity, usually what happens is spreads tend to remain wider unless people want to market make that name, if the name is not going to trade as much. Right? It just happens. Unfortunately, that's going to be the case for 99% of ETFs, is
Yeah.
because no one wants to warehouse positions. Especially the market makers don't want to warehouse positions and lose on the financing aspect of it.
Is this where we do our obligatory be careful before you join the ETF ecosystem because you need to understand these aspects of it?
Well,
Um,
that's definitely part of it too, and this too. Like launching an ETF is not it's not cheap. It does cost several thousands of dollars. Plus, you need a legal team, compliance team. You need educated capital markets people. You need a distribution aspect, right?
mhm.
So these are the things that people don't think of. They think, all right, let me launch an ETF and maybe um, use the tax efficiencies of it, but there are actual, dollar costs that are required to actually create these funds.
Yeah, and they can be and they're ongoing, right? And I think that's
Right.
the part that people forget. It's not just about launch; it's about ongoing operating, and it can get up there if you don't have traction early in the game. And speaking of that, like it obviously launching an ETF that has existing AUM or early adopters or maybe even a conversion from a mutual fund, a lot easier from the AUM standpoint. But would it be fair to say that if you have early adopters teed up for an ETF launch, that they slowly uh, allocate to the fund to keep daily volume up? Is that something that would be uh, a positive thing, or is that something that's just sort of a fool's gold?
Yeah, so one of the things I kind of struggle with when I talk to different issuers is like, hey, if I convert my mutual fund to an ETF,
Mm,
will that help, right? At the end of the day, you still need end buyers looking to purchase that ETF, and and now what you've done is you've essentially uh, lowered your own management fee if you've chosen to reduce the expense fee from the mutual fund expense fee to an ETF expense fee. So some mutual fund companies have not done that, but some have, right? So you're basically giving yourself your own pay cut, right?
mm,
In hopes so that of other investors buying that ETF. Sometimes you don't get that, right? Sometimes
yeah,
you'll see outflows because sometimes we've heard, like especially during COVID, uh, mutual fund companies weren't allowing redemptions in their mutual fund for large amounts of size. They were actually preventing large redemptions from happening. But
yeah,
now, if some kind of market event happens, if there's an ETF, you could probably get out. of that ETF much more easily than the mutual fund. So um, it becomes like a good problem and a bad problem. One, you're helping the
Right.
investors with the tax efficiency and creating a lower expense fee product, but two, you still need you want new buyers as well as your retain your old buyers of your current strategy.
So what at WallachBeth, for example, what does your radar look like when you think about new issues and things you're going to pick up and start quoting? Is there a sweet spot for you? Is it, what characteristics have to assert themselves before you think about picking up a name as a market maker?
Well, what we do is a little bit differently. We work as an agency
Right.
broker. So what happens is, if someone is looking to source large liquidity in any single name, whether it doesn't, we don't really have a AUM size for a client that we work with, but basically what we do is we help. We always try to have a conversation with our clients. I think half my time is more just educating rather than actual trading. It's we just discuss with them, hey, what are your needs? And like what we talked about before, round trip costs, what is your execution plan, right? Are you looking to spread a name over the day? If, hey, I see on-screen liquidity very low, any ways to mitigate that spread impact if I had to buy that name or if I had to sell, right?
Right.
But we don't really pinpoint a certain issuer or a certain ETF as far as what we choose to do, trade. It really depends on what our clients are asking for, and we'll try to give our agnostic approach of trying to execute that trade.
Okay. So it's fairly fluid from that perspective,
Right.
depending on demand. Got it.
Absolutely.
Alright. I know we're pushing up on 15 minutes, and I promised the audience and the guests that these are fairly quick hitters. Um, any last piece of advice you'd give to either ETF issuers or investors in the marketplace when dealing with capital markets, dealing with quotes, dealing with large blocks?
I think if you ever have any questions, always reach out to a cap markets desk. There's no such thing as a dumb question. You will always want to be able to educate yourself. At the end of the day, you're talking about real dollars, and you want to make sure you can you can get in and out of a name where you feel comfortable with it, and you don't have inhibitions about trading a certain name. So always ask a question. Talk to someone like you and your team. Um, and I'm sure you'll be able to find the right answers.
Yeah, and it's all about education. That's like as long as we can continue to match expectations with reality, then the business only gets better, right? And I
Absolutely.
think that's an ongoing job, and we're happy that folks like WallachBeth are in the game with us to help investors understand the marketplace and trade and allocate correctly. So, Mohit, thanks for your time. Thanks for everything you
Appreciate
do
it.
at WallachBeth, and we'd love to have you on again. So hopefully we'll talk soon.
Sounds good. Thanks, Mike.
All right, thank you.